What's up, Mortgage Coach community? It is Friday mastermind time, and I've got my man, my main man, wingman, Todd Bookspan here. What's up, Todd?
Hey, good morning. Nothing much. Just always excited anytime I can learn from Dan. Those who know me well know if I could do it all over again, I would study economics a little more because I'm so nerded out by it. But I don't need to because we've got Dan Rawitch with us who could educate me, so I don't have to do it myself.
You flatter me too much, but thank you.
Well, you are a massive gift to the industry and a huge gift to the Mortgage Coach community. For any new loan officers tuning in, Dan is the chief economist for Mortgage Coach, and for well over a decade, we're almost going on 2 decades. We're closer to 2 decades than we are to one. He has been doing a daily update in the Mortgage Coach community, where he couple minutes every morning. He puts a video in our Facebook group, just netting out the market. Hey guys, this is what's happening. This is what it means to you as a mortgage coach. Someone that is an advisor in the market. He's also got other platforms where he teaches trading. He has a market mentorship program that if you really want to be a market nerd and have access to Dan daily, which I do, I subscribe to that service. I even get a few stock picks that are outperforming anything else that I'm doing in the market, although I'm laying pretty low in the market, unless it's something that Dan says to play with. So Dan, for any new loan officer that's listening to this, because new loan officers they're still coming into the business. They're not flooding because nothing is flooding in the mortgage industry anymore. But Todd and I did an interview a couple of weeks ago, and it was just updating the new loan officer playbook. So if there was a new loan officer that never heard of you, tell us who you are in a minute.
Okay, so I've been in the industry since I was a sophomore in college. I originated my way through college. Then my dream was to become a bond trader on Wall Street, and it came true. About a year after I graduated, they recruited me, and that was just a wild experience back. That was early 80s. If you saw Wolf of Wall Street, a lot of that stuff really went on. It was obnoxious. And then I really didn't like being in Manhattan, the whole lifestyle. And I mean, literally, traders were snorting coke on the way to work in the bathrooms. And I'm not a choir boy, but that's not who I am. So I begged them to relocate me to San Francisco, so I was closer to home. And at that point, I became an asset liability manager for major institutions. So that involved a lot of hedging, stuff like that. And then I founded RPM Mortgage. I founded DataFax, which is a credit reporting company. And that's enough for now.
All right. So guys, he's sat in a lot of seats in the mortgage space, ranging from originator to manager to CEO to change agent. And now for a long time, he's just helping loan officers turn market, what's happening economically and how that impacts interest rates in a way that you can make better decisions. You can give better advice to both families and referral partners like realtors. So Dan, tell us, what you think we should be paying attention to in this marketplace. And then of course, I am going to want to know, your forecast of interest rates. I'll look in a minute. One person on Facebook had asked, what's the lowest rates ever got, without Fed help? So they just kind of have a sense that if we don't get more help, where might this go? So where do you want to start, brother?
So I have slides if you want to go through those, or we can just be conversational. Totally up to you, Dave.
Well, no, let's start with slides. Slides, and then we'll see where to go from there.
Okay. I'll really race through them, and then I'll give them to everybody. And maybe just like, if you're listening, because I will go fast, maybe just make a note. Like if you see something that was interesting or that you didn't quite understand, it would be great, because we'll leave time for some Q&A and we'll get to that. So I'll start hot rodding through these things real quick.
Hey, and I do want to call out, guys. I hope everybody is building, slides of insights. I constantly study which loan officers are most successful in every marketplace. And in this marketplace, having, at least 5 slides, probably not more than 20 slides, call them insights and things that help you educate, both partners and realtors. You should have something. So Dan's going to share all of his deck, and my guess is there's going to be a number of these slides that you're going to want to add to your insight slide. So If you do want a particular slide, or there's a slide that you think is really like, that was money, I'm going to add that to my insights deck. Let me know. I want to know, and Dan and I want to know, what do you think is most valuable from the presentation at hand? So let's roll, Mr. Rawitch.
All right. All right. Thanks for the backdrop. I thought I'd start with just a quick story, because some of what I'm going to show you could seem to be not great news, but it's really not like that at all. And some of you may have heard the story. I heard it on a TED talk long ago called Good Thing or Bad Thing. And the way the story goes is a man's prize horse got out of the barn in the middle of the night during a storm and ran away. And neighbor came over and said, "Oh, dude, by the way, this was back during the Civil War, so he probably didn't say dude. Oh, dude, I heard about the horse. It's just terrible." And the guy that lost horse goes, I don't know if it's a good thing or a bad thing. And the neighbor looked at him like, "You're really strange." So the next day, the horse comes back and he's leading a whole bunch of Mustangs, wild Mustangs. And the horse literally leads him into the corral. And the neighbor comes over and says, "Oh my God, that worked out. Wow." And the guy said, "I don't know if it's a good thing or a bad thing." So the next day, his son, who was grown, 18 years old, said, "I'm going to break one of these Mustangs, Dad." And Dad said, "Go ahead, have at it." Well, he was thrown really badly and he broke his leg, the femur. It was a terrible break. Of course, the neighbor comes over and says, "Oh man, I heard about your son." And the dad's like, "I don't know if it's a good thing or a bad thing." The next day, a sergeant in the army, in the Confederate Army, knocks on the door and says, "I know you have a son. I know he's 18 and he's going to have to come with me and fight." And the dad said, I don't think so. Come on in," and showed him. And the kid's leg was up and elevated and a big old cast on it. And the sergeant said, "You're right. He can't fight. He gets to stay home." So you don't know, where things lead. Well, that's the story. So just remember that there's no bad, only news, because everything that I tell you, there's something good about it, honestly. So first of all, many of you have seen me talk about the time cycles before, and these histograms represent times in history that could go back 10 years, 20, 30, 40, 50, up to 400 years. And a model was created, 100,000 square foot warehouse was timelined all around the walls, and then some, of every major event that ever happened, everything. And then it was put into a computer model and these histograms were created. So these are very, very predictive. And what you can see here is when there's more of them or they're taller, it calls the bottoms and it calls the tops of the market to the point that it's almost eerie. So you have to believe in time cycling over and over. And that saying, history doesn't always repeat, but it always rhymes. These things just keep coming back. So here's another example of histograms calling the top, calling the bottom. Excuse me. And so the guy that developed this, I just thought I would show you June, the beginning of every single, actually, I'll show you. No, that's not it. Sorry. The beginning of every single month, like literally on the 1st or on the 31st, I get projections on what the histograms are telling us. And so this was June, and these were the dates on the histogram, and you can see that it perfectly called top. And the next histograms were down here, and they perfectly called the bottom, called the top, called the bottom. Now, sometimes these X's can be like accelerated growth. They're not always reversals. And usually when you get kind of at a major point of resistance or support, this is called a pivot point, this 3810 on the S&P. And the reason it's called a pivot point is look what price did when it hit it. It pivoted really severely. And these pivot points usually end up being resistance on the way up. So I found that when we get those histogram dates and they come around a pivot point, that I can really believe that that pivot point is going to get broken through. And it was. So, and then these are July dates. So what do I make of all that? And we have to talk about the stock market because it's really having a huge factor on family wealth and 401ks and people's attitude. And I talk to people every day. Should I get back in, or I'm down 40%? What should I do? And it's hard. So here's a couple things to think about. 120 years ago, which is a cycle, 1902, the Dow made a low. There are three patterns of 30 years apart, which makes a harmonic pattern. So here's what this is telling us. If you break down these cycles from that low, July 18th, 1972. Now think about where we are right now. We're like July, whatever, 21st. The Dow made a major low, and this is a 50-year cycle. More importantly, half a 100-year cycle. And then 1950, the Dow made its low for that year, again, July. This represents a 72-year cycle, which we often use. Finally, slightly out of phase a few weeks, in 2012, the Dow made its low for on June 4th. That was the 10-year pattern. So what's this telling us? What it's telling us is we may have seen the bottom of the stock market. I'm not fully ready to say that or fully ready to believe that, but I've learned over the many years to not doubt these cycles, to at least, give them credence. And some of you may remember, I wish I could remember the dates better, but Dave had me on, and these cycles were coming together and causing almost a bizarre event, and it affected interest rates. And I have seen the bottom. And this was after a really long, terrible drop. And it was true. The market just rallied and rallied and rallied for quite some time. So 1962, the Kennedy slide occurred, and then you can see what happened. 1932, this is after, the great 1929 crash. That was a 90-year cycle. The Dow hit a low, a final low. Okay, so now take these cycles now and let's talk about inflation, because we are in a very strong inflationary cycle. And and by the way, this year is a war cycle and kind of a revolution cycle. So this could be a very interesting year. So inflation moved up after the Napoleonic Wars in 1810, the Civil War, 1860, et cetera. And so we are in this cycle. It's not just about war. It's about the years that these are apart. You can see 50 years and 50 years. Okay. So we have these episodes of inflation post World War II. And so the point here is almost anybody could have seen this inflation coming if they were looking at these cycles. There was no surprise. And the Russian conflict, there was no surprise. That is coming together after 400-year cycles, specifically union. Okay. So that kind of says I'm not too surprised about inflation. It doesn't necessarily tell us where the bottom is, but I think that the peak could be in. Now, this is kind of cheating, but if you look at inflation month over month, well, with these high months, it's not going to take much to start seeing it drop. So inflation might not go anywhere, but if you're comparing 6% to an 8%, it starts looking like it's trending down. And these guys at Real Investment Advice, pretty good analysts. Okay, now some of these slides are about the economy, and the economy is, I would tell you, very unhealthy, very, very unhealthy. And it's going to put the Fed in a huge box. He's in a box. He's got to decide how much destruction he's willing to inflict on the economy and on the market. He's got to stop even talking about a soft landing. It's not going to happen. And what's happened now is, if you look at Google searches, if you look at most analysts, talk has become about recession, not inflation. And that's a good thing. Not that a recession is always good, but good thing or a bad thing. It's going to drive rates down. I think I don't know that we'll see a sub 1% on the 10-year but it is possible. And I firmly believe we'll see a sub 1.5%. And that could happen this year because of this. So first of all, the case freight index, this is how much, basically looking at shipping costs, finally down. You can see what happened during the pandemic. Terrible from here to here. Well, it's finally starting to come down. Number one, the shipments are coming down drastically, and the prices are beginning to fall on downtrend. And if you've listened to me for any time at all, you've heard me say, when the supply chain is fixed or mostly fixed, inflation will end. And I have really strong reasons for that. We'll see if we have some time. So this is the used car index, and oh my gosh, I sold a Ford F-350 pickup 2017. We paid about 67,000. We sold it 5 years later with 40,000 miles for 65,000. And we sold it to Carvana, which I guess that's why they're going broke. But look at this. And so you have to remember, inflation breaks down as two levels. You have core inflation and you have headlines inflation. Historically, economists, analysts don't talk about headline inflation because it's got food and energy in it, and food and energy is too volatile. You really can't get a read. That fact is annoying to a lot of people, because if you go to the grocery store, go to the gas pump, like, how can you not look at headline inflation? We have been stocking up on food pretty aggressively, and we're doing it for two reasons. Primarily, we could see food shortages. Certainly, we're going to see food shortages across the world. And I think that they really could affect us. And if it doesn't happen, which I pray to God it doesn't, my wife is buying stuff, like 10 pounds of flour and telling me how much that costs. And then a month later, she'll buy another 10 pounds and, put that in storage, which, by the way, when you're full time in an RV, it's really interesting. This thing is so loaded. And they just keep going up and up and up and up and up. That will stop, but that might get worse before it gets better. But the Fed really has to look at the core level inflation. And in the core level, we have things like this. This is a big driver, vehicles. Where was I going with that? Tourism, shelter, all those things, have a huge effect on core inflation. And as those drop, rates are going to fall pretty fast. So this is interesting. This is the Fed, the Atlanta Fed. That's part of Powell, right? Who said everything's fine. He keeps saying everything's fine. He keeps talking soft landing. I don't know if he believes what he's saying. I've always thought he was an honorable guy. But if he's honorable, and he's stupid, and I never really thought he was stupid. So he's either lying or he's dumb. Look at this. This is the Atlanta Fed. They keep a model that's constantly updating itself over and over and over. So you can see back in May, they were calling for 2.5% GDP. And now they're calling for a negative 2%. And that number's coming out next week, guys. This is a huge problem for the Fed. First of all, the Fed's created every recession, certainly the last 7. If you look at every single rate increase cycle, it was followed by recession. And now we have recession where we really get into the rate cycle. And next, we're also going to hear from the Fed. That's going to be really interesting. I'll talk about that in a few minutes. I firmly believe, and I way this creates a lot of passionate discussion, deflation is going to be the problem. I firmly believe 1 year from now that we're not going to be talking about inflation. We're going to be talking about deflation. And this slide does a pretty good job of explaining why. One thing to watch is commodities. And I've got some slides on that. Commodities just went through the roof. And when commodities started shooting up, of course, inflation did. And of course, interest rate does. I'll show you slides in a few minutes. Commodity prices are falling like a rock. Copper has always been considered a leading indicator, and copper is just very sick right now. And then there's something called the copper to gold ratio, which was kind of discovered by Jeff Gunlock, who is considered the self-proclaimed bond king, which I think is weird when people give themselves nicknames. You can call me Spike. How's that? So the copper to gold ratio suggests much lower rates right now. This is the NFIB survey. This is firms expecting economic improvement over the next 6 months. And this is lower, I believe, than it's ever been, but it's lower than the Great Recession. It's lower than the dot-com crash. It's lower than the 90s recession. Just think about that. And the Fed's going to increase rates right now. This was good news. We're seeing funds actually flow back into bonds. So this last week was minus 6 billion. But that's equity funds. I want to look at bonds. Fixed income went from negative 67 billion. That's money leaving the bond market to negative 18 billion. So it's beginning to correct itself. And by the way, this slide's almost a week old. So I'll be updating this Sunday when I do my video. This is the economic output index, and it's now below the line. And it's pretty much only goes below the line during recession. These gray areas are recessions. And so here we go. Philly Fed, which came out so bad. This slide was done before Philly Fed at the beginning of the week. It's crushed. It was negative 12%. And S&P earnings per share follow very closely the Philly Fed. And the reason you should care about earnings per share is if they start dropping, the stock market's going to free fall. So this is a really interesting earnings session. And as terrible as it is to see family wealth bleed out, it ultimately ends up being very, very interest rate friendly. I thought this was interesting. This is just a look at the current board, the Fed board, who's dovish and who's hawkish. And it's always the same people, by the way. Same people are always bullish. So a little bit tilted toward bearish, right? Maybe more than a little, but it's not like the whole board is hawkish right now. Okay, now some home price stuff real quick. By the way, Dave did one of the most incredible pieces of research I've ever seen called the Halftime Report. And some of this data I'm going to show you is in that report. But guys, if you haven't looked at that report, you're really missing out. I mean, he interviewed some of the top minds in the nation in this industry. I was totally honored to be in that group. I mean, people out of my league. Good data.
But no, hey, real quick, I want to jump in. So first of all, no one is out of your league, Dan. And I did interview some of the best minds in the industry, and I'm still interviewing folks every week and adding to that halftime report. And the goal was for anyone that follows Mortgage Coach, Sales Boomerang, this no borrower left behind mission, is we want to give you a competitive advantage. So we will put a link to that down below. I did that with Kristen Messerly, and her and I had never spent more time on a piece of content that we created, and it's got over 25 interviews. And I do want to call out to anyone checking it out that if you scroll down towards the bottom, not only is there a link to every interview, and there's a playlist in our YouTube channel so you can watch it, listen to it, but there's a transcript for every one of them. So you can either click and read it, or you can click and watch it. And it really is some incredible information. So do check that out. Also, I want to remind everybody that this is a mastermind. So if you've got a question, you've got a comment, put that in either the chat of Zoom. We've got a bunch of people in Zoom, and then we have even more people on Facebook. And if you're watching this on YouTube and you have a question, we'll make sure it gets answered. Todd, is there anything you want to say or ask Dan before he keeps rolling?
Well, I got a lot of questions for him, but I don't want to ask him in case he's going to answer them in his upcoming slides. I just wanted to reiterate what you just said about the halftime report. I mean, it is a competitive advantage for the loan officer who's going to take time to mine it for gold. And your real estate partners, your clients are counting on you to be the professional. And Dave and Kristen kind of gave the easy button. They summarized what all these geniuses in the industry said. I watched most of the videos, but it's just an easy way for you to go pull out some interesting tidbits for you to have as your weekly conversations with your partners and your clients. And that is what I love about, Dave, you and your new role as the Chief Innovation Officer of the industry.
I like that of the industry. And hey, one more thing, because I'm writing up a homework assignment that I'll be posting in our Facebook group any day now. But I've been hearing from a lot of branch managers, regionals, people that are responsible for the success of others, where they've been assigning this thing. I've had a number of heads of production that said, hey, I gave this to everyone, and I said, hey, I want you to read this, and I want to know what you think is the most important takeaway or the thing that you're going to do differently from this. So I would encourage anyone that is the responsible for the success of multiple loan officers to assign this as a reading assignment, and to not just test them that they did it, but find out, hey, like, what was the signal to them? What was the key takeaway that's going to add most value? And then have a sales meeting around it. So I'll be assigning that in a kind of a leadership style on Monday or Tuesday. And in the meantime, if people are getting big takeaways from it, let us know what they are. Back to you, Dan.
All right. So I thought this was interesting. This is home prices going back to 2010. They were still falling a bit. You can see here in 10 and 11. And then we had what I would term is very normal and healthy appreciation. This was a little big, but if you go back 40 years, appreciation's been about 5%. That number is probably skewed now just because these numbers are so huge. So, you can fact check me on that, but I'm going to tell you 5% is probably not far off as a 40-year average. Now, this is what I find interesting. 5%, a lot of borrowers, I've heard them say it. Well, this is not very interesting. Well, wait a minute. If you buy a $500,000 house, and let's just say you put down 10%, you're putting down $50,000, right? If that $500,000 home appreciates 5%, that's $25,000. That's 50% return on your equity. Double that, let's say you put down 20%, now you put down 100 grand and you had 25% appreciation, and you had 25,000 appreciation on that $500,000, 25% ROI. How are you going to beat that? I mean, I'm a stock market and options guy, and I'm going to tell you, you're not going to beat that in the market. Well, I do, but most people don't. So I think there's great hope for the housing market. And I know there's been so many slides and conversations about this time's different. And it's not just different because healthier through this entire process. They've been qualified. They had okay credit. They had income. But how many people are going to want to walk away from their 2.5% interest rates? That's going to keep people, I think, in their homes, because what makes a market crash is panic and everybody starts dumping and then prices fall. I just don't see it. I do see a softening for sure. But when I look at things like this, home ownership at 65%, it was 70%. Now, unfortunately, that probably was bad. I think that was Clinton back then. It was a noble idea. Anybody in housing would have loved it. But what the industry did to try to make that goal was horrible. That's where the whole subprime stuff came. But there's room, big room in the amount of home ownership. So this is
Dan, real quick. There was I did a post on LinkedIn a couple days ago where I talked about the percentage of what do you call it? Commercially, institutionally owned real estate.
Oh yeah, I saw that.
Is that built? Is that built into this?
Built into the percentage of ownership?
Yeah.
Yeah,
like
I don't know.
Like what it said, is that built into this number? You probably don't know.
Yeah, I don't. I don't.
The slide before. Okay, well, something to talk about and think about. And check out that LinkedIn is a couple days ago, guys. Comment on it. I'd love to hear you.
I have an educated guess, and that would be, I believe that figure is owner-occupied homes, not investment properties. Sure. Again, fact check me. This is a pretty realistic prediction, is in my opinion, about where rates probably will be heading. And what this is telling you is we probably have seen the top, and there's a lot of reasons that I believe that. What could undo that is if the Fed stuns us this next week with a 1% increase. This is pretty good. And when I show you commodity prices, I think you'll understand why I believe this. There's also a kind of a fundamental reason, and that is if you look historically, at stock dividends, 2.5% is considered pretty good dividend. The 10-year gets above 3, it's kind of sexy for people that are dividend hunters. Bonds are much safer than stocks. This is where we think GDP is going. I actually think this is worse now. And you can see this is Q1 22, Q2 is coming out. You already saw the Fed GDP now. It's way down, -2. I'm really surprised by this. Single family home construction is nowhere near where it was in 2002, 2003. With all of this housing shortage and all of these issues we're having, and builders' stocks have been skyrocketing and builders have been flush with cash, why is this so much lower than it was at the peak? But again, it just tells you there's room for this market to continue to grow. This slide got kind of messed up, but think about this as younger than millennials, then then as you're kind of progressing up to the generations. And this is baby boomer, and which is me, and we like to say dyers aren't buyers. So that's going to be a real fundamental shift in the economy. But also it just gives a lot of room for growth. Yes, this is going to continue to fall, but all this could continue to rise, mostly here. And then again, I'm sharing with reasons why I don't think the market's going to be hurt very badly. I do think we'll see a softening, and I think it's very healthy. This is Reuters. They wrote the article as if it's fait accompli, like it happened. Fed to stick to 75 basis point hike in July, and that there's a 40% chance of recession. I don't know if they got some inside info. I really don't. I read the article, and it really reads like the Fed's going to go for 75. That's what most of us. But there's a kind of slight fear. 1% to less than 15%. So more and more we're seeing this number probably will materialize. So if it does, probably won't hurt bonds very much, if at all. Okay, so this is the CRB index. This is a basket of commodities that I still have kind of COVID brain a little bit. And it includes copper, gold, and corn, and wheat, and all kinds of stuff. And what you can see is by the way, this orange guy is interest rates. And so this was as we came out of the pandemic. And you can see this was kind of the bottom of the pandemic. And then you can see how commodities just kept going up and up and up. And you can see when commodities started rising, man, interest rates fall. And one of the reasons I started getting bullish is the divergence. So this is the same thing, but going way back to 2005. And I can't stand how I cut these slides off. And what you can see is commodity prices. That's the candlesticks are commodity prices. The orange guy is interest rates, orange line. And commodity prices just been in a free fall for many, many years. We've really been more deflationary than inflationary at the core level. And you can see how interest rates just followed commodity prices all the way down, and then the pandemic. So this puts things in perspective for me, what happened after the pandemic. We broke this really long downtrend, and up they went, and look at how interest rates just turned up. Well, now they're coming down pretty fast. You can see that here. They hit this top of this range and fell pretty hard. If I update this, we did have a little bit of a bounce here, but it certainly seems like they've begun a downtrend. And then this is a recent, yesterday slide on treasuries. And let's talk you through this real quick. First of all, I have to brag for a second. What you see here that I created called Flight Station, and it's actually been blowing our minds in terms of over and over and over. 1,000 lines of code in this thing that we developed. But it also summarizes every candle, and it tells you if there's more bullish force or bearish force. Currently, there's more bullish force. So what that's telling you is there's a little more upward pressure here than there is downward pressure. You can also see, however, this is I don't know if I should talk about Fibonacci. I feel like I have talked about it so much. If you throw it questions, if you want me to talk about Fibonacci when I'm done, and this is my last slide. But Fibonacci is pretty incredible, and we use it in trading. And so what we do is we take it from the recent lows to the recent highs, and this is telling you what percentage is happening. So meaning it came right down to the 38%, 38.2 Fibonacci level. Those are Fibonacci numbers. That was 2.80 on the price. And then it bounced up, and look at how perfectly it's held this Fibonacci 3.05 level. It just doesn't want to break it. And this actually becomes pretty good for us after a bit, because there's some point here. How many touches? 1, 2, 3, 4, 5, 6 touches. Plus you have to count the touches on the other side. So at some point, typically price will capitulate. Just go, okay, fine, we can't break through. Let's just go down. So I believe that now that we've touched the top, this makes me a little nervous, a little more bullish force, but the next step should be down to 2.74. And I think we're going to start seeing that happen. The big caveat is next week we have GDP, we have the Fed, we have all the what's called PCE, which is personal consumption expenditures. The Fed will watch that more than CPI. So it is going to be a wild week. You want to be real careful. That's all I got.
All right, Dan. So real quick, because you kind of mentioned your services up front, and I've been a member, since, I think just after you rolled it out. So, I'm a member who uses it. I love the weekly slides I get. You send out the slides every, something similar to this, 20-minute plus or minus video. And to me, that's the big value that I get from it. You also are given stock picks, which every week I'm like, shoot, I should have done those stock picks. Although I did do some this week, and I'm up like almost $1,000.
Sweet.
But, for me, set it and forget it. And so kind of give it a quick overview, if you don't mind, for everyone else who might not know what the services that you're offering, because I think there's things that you do that I have no clue about because I'm not paying close enough attention.
Okay. So, the really big thing that I do, you can go here, dolikedan.com, and that'll take you into a video that kind of describes, the whole options trading program. And the reason I even bring it up, because, normally I just talk about Market Mentor, which is extremely inexpensive, maybe too inexpensive. We have a huge membership. It's a good business. And that's the weekly video, daily updates twice on a private Facebook page, and then content almost every day that could be repurposed. But, as the industry slowed down, the demand for people that want to make some extra money it's been shocking. So the program that we sell includes everything somebody would need to know on how to trade options. But the big thing is, if you can trade 1 hour in the morning with us, we make money almost every day. So just keep that in mind. If you're interested, go to dolikedan.com and you'll get the whole thing. And then, of course, Market Mentor is, much more inexpensive. It's more for loan officers that just want to stay current in the market. But thanks for asking, Todd. You're always so good about that.
Good stuff, guys. So we'll put links to those. And I am a member of both platforms. Although I don't trade every day, I do watch that Sunday video, and I do make some bets on many of Dan's recommendations. And I feel like I'm smarter all around as a businessman as a result of being part of that. And if I was a loan officer, I would absolutely do Market Mentor, because it's just a great resource. And just the content you're putting out there on a daily basis helps. Remember, guys, and by the way, Dan, you can stop sharing your screen. Let's do fireside chat until we have something that we want to share on the screen. But I want to remind you guys, you should have an insight slide, and there's just great content from that. So Dan, here's some questions that came in on Facebook. Matt Cady will give his question first because he asked it first. At least I think he did. What is the lowest rates have been on their own without QE?
It's a really strong question. I recall being a really big deal in the 90s. I think it was like the 92 refi craze, where the 10-year broke 3%. So the huge 3% was always a huge milestone to break. That's probably close to the lowest we've seen without Fed help.
So 3% without Fed is the right now the Dan Rawitch answer. If you don't mind if it changes from that, let us know. And there's actually a comment in our Facebook group on that. Maybe Matt, hopefully you're listening. I'll make a little comment. Dan said 3%. Okay.
And that's a we'll call it as educated guess. Again, something I don't want to fact check.
Yeah. So if anybody gets a different number and fact check it, let us know. So Dan says 3%. Remember, guys, be following our Facebook group. And when do you think that was? In the 90s? It was in the, what year do you think it was?
Well, it's happened a few times. But the 90s was a pretty big opportunity.
I'll just say that it happened a few times. So
yeah,
he can watch the interview if he wants more. And then this came in from what's the name of this person? Why isn't it showing me the name? Oh no. Hang on. Here we go. Greg Coart. So Greg, thanks for a great question. I'm not going to read your whole question because he really nets it out. Because you often talk about like the Fed chair as though like they're the decision maker. And he said, well, but aren't they really not? Aren't they just one of 7 votes? So he just wants to know, is the Fed chair any have more power than just 1 of 7 votes, in your opinion?
No, not really. I feel like, the Fed chair historically has guided. Sometimes had to synthesize a lot of data, can be a tie-breaking vote. But that's actually true. I mean, the Fed is really just reporting a decision that was made. And that's why I showed that. That's not specifically why, but the Fed's who's hawkish and who's dovish. I think it's really important to keep track of that and which ones are voting members.
So they're an influencer. Out of 7, they can be the tiebreaker. I mean, essentially anybody can be the tiebreaker out of 7,
right?
But,
yeah.
But they are an influencer. So they have the most influence, would be fair to say, but they are only 1 of 7 votes. All right, Greg, good question. So Dan, couple things, so everyone in the mortgage coach community that is, a member of Mortgage Coach has Rate Watch. So on a daily basis, just remember to everybody, you've got what's happening in interest rates on your mobile phone. Green is good. That's what's happening. Want to remind everybody that there is a day watch. This is one of the most commonly used screens within this. And just want to remind you guys that you can just click share in the upper right-hand corner. You can email it, you can text it, you can put it on Facebook, you can clipboard it and integrate it into an email or some marketing piece. So just want to remind everybody, when it comes to monitoring the market for consumers, you've got a great app. Any recommendations you have on, if you were a loan officer today, how you would be using Rate Watch, or, knowing that we have hundreds, potentially thousands of loan officers watching this, any advice on how to use the Rate Watch app and when to use the Rate Watch app?
Well, there's another feature in there that I really like, which shows average rates. It shows rates by FICO, rates by LTV, and I think that's a great tool for consumers because they get some wacky, as there's a lot of there's a lack of integrity out there with some of our constituents, and they like to quote last week's rates or tomorrow's rates. And so I sending that out when somebody says da da da. You know, the catch-22 is maybe your rate's worse than the average rate, then don't do it. But usually the average rates look high to most originators. And you know who's been really good for many years about doing what you said, I think even before it had the share button, is Scott Nicholson. He would create urgency, still does all the time. You know, hey, look what happened today. I know you're thinking about doing something, but look at this day watch, because it creates urgency when people realize that bonds move like stocks. They don't just sit there.
Yeah. So a couple things. He is referring to the tab that we call mortgage market indices. And that data is powered by Optimal Blue. So through our integration partnership, we've built this into the app. We've also built this into the advice engine. So the same place where you're creating a total cost analysis, you have this data, as well as we have a new Rate Watch Lite in that. So just want to call out, guys, we've got a lot of tools to help you monitor the market, be able to make that claim to a consumer that, hey, rates don't change daily or weekly, they change like minutely. And I've got my finger on the pulse. I've got, you know, chief economists that I'm listening to. I've got data, and you can just be there to help serve the customer. Todd, any questions you want to make sure we ask, or any from a, you know, win by noon leadership position, anything you want to make sure we cover?
You know, absolutely. I mean, I think the bottom line is you guys said it, you know, you said Scott Nicholson is creating urgency with it, and you've got a tool that's included in your mortgage coach membership. So I would just encourage you to just take a few minutes when we get done with this call, and then play with the app and learn, and then share with, you know, your spouse or someone, a friend of yours, or share with yourself in some way, so that you can take a look at the data. Because really that's the whole need of your consumer, right? You can tell them what you can tell them, but when you can show them, then that just goes a little further. So that's my thought there. But, you know, really my question for you, Dan, is you said a couple of things. You showed the chart where the 10-year is going to, you know, probably go down more towards like 2.5 towards the end of the year. But you also said it could actually go to 1.5%. I mean, what do we need to be watching to know whether, you know, what direction and how fast it really will get to 1.5% or even lower?
For the Fed to blink. And what I mean by that is, you know, right now he's extremely hawkish. He won't acknowledge that the economy is unhealthy. That's a concern. And when we really start nosediving, he's going to have so much pressure on him. And I think we'll see him start shifting first to neutral, then to dovish. And I do believe that inflation probably has peaked, except for food and energy. That's going to take a little more time. So I think when the Fed can acknowledge that, it's probably like maybe 1 or 2 months of the PCE numbers, personal consumption numbers, and the Fed sees the economy nosediving, I think that's when he says, whoa, I can't do this anymore. I actually believe, this might be a little too aggressive, but this next rate increase could get walked back by the end of the year. I said this in 2017 that he was being ridiculous. It doesn't mean I'm right this time, but it's very possible.
So if you had,
that's interesting. And what about
Todd?
No, go ahead, Dave. No, you asked your prediction question because I was shifting gears. So keep asking yours first.
Okay, yeah. If you had to predict rates in Q4, what number would they start with, and would it be, you know, mid or high? Just give us some directional end of year Dan crystal ball forecast. Did we lose Dan?
And all that.
Hey,
can you hear me?
Dan, we lost you for a minute. So if you could answer that again, start over.
Yeah. First, I was qualifying my answer just by saying there are a lot of unknowns. Yeah, I'm getting an internet unstable message. Sorry.
No, we're hearing you. We're hearing you now.
Okay.
There was a moment where we didn't.
Okay.
You're back.
Yeah. So assuming we see some easing on inflation, assuming the GDP number comes in as weak as I think it will, I think we'll break 2.5 in the fourth quarter.
Really?
On the 10-year.
Oh,
no, on the 10-year.
But what will rates be? You know, just because, you know, there's dynamics that impact the margin between the 10-year and rates. You know, where rates going? Interest rates. What are loan officers going to be quoting in Q4?
Yeah. So historically, we see like a 1.5%, 1.75% spread between the 10-year and mortgage rates. Right now, the spread is really big. What are fixed rates now? 5 3/4. And we have a 10-year at two and call 2 3/4 is a little aggressive, but that's a 3% spread. That's really big. So if I even take that down to 2% and I'm right about the 2.5, we could see 4.5, 4 3/4 in the fourth quarter.
Okay, good. Well, thank you for that, guys. If you have questions for Dan, this is the time to ask them. Back to you, Todd.
Well, I was shifting back to the stock market because one of the things that I was most grateful for on your advice was early in the year. It was after you had already done it, but again, I must not have been paying attention when you did it. You mentioned, I moved my money to cash because I think the S&P's going down, and at that point it already was. So I was able to save a lot in my 401k, my personal portfolio. And so you mentioned that some of the charts are showing that the S&P could still go up, but you're not convinced that we've hit the bottom yet. What should we be watching for there, and what do you think the time frame is for a true bottom there and for it to come back?
Yeah, so two things that always come last. One is a decline in jobs. So I think we're going to see that soon. And the second thing is a decline in earnings per share for companies. Those are usually the last things to come. So the Fed keeps talking about this strong job market, but of course, that hasn't happened. That's in the coming chapter. So my concern is that earnings per share will get hit for companies as the jobs begin to fall. And as you know, stocks are valued on their earnings. And so that could take it lower. This particular earnings season we're in is going to really tell us a lot in terms of what kind of guidance companies are giving. Like Snap, they stock dropped 25% today just because they gave really poor guidance for the coming quarter. And that's trackable on my weekly video. I usually have, an EPS run rate. So one, we got to make sure that's bottomed. And when that's bottomed, you probably can start believing the stock market's bottomed. And just as a point of fact, the stock market always bottoms before recession. So because everything just gets priced in. So recession's coming soon. I think the stock market bottom's coming soon. And then if you want a more just really actionable thing, if you look at the 50-day moving average, which is actually this pink line on this chart, when you see the
pull it up real quick.
Sorry, I forgot I'm not sharing.
It's okay.
So how far back would you go to look at the 50-day moving average? Is it just year to date, or are you going back, a year, 5 years, 10 years?
So the answer is 50 days, because that's what it does. It calculates. I didn't mean to be a smart aleck. It calculates.
It's okay. He had it coming.
No, I'm trying to show out. I'm trying to show my brilliance in the stock market.
Yeah. What's that? Who's buried in Grant's tomb?
I had that joke going on in my head. I was going to say it. But, great minds think alike.
Yeah. So, but here's where there's validity to the question. If you could be looking at a weekly chart, monthly chart, or daily chart, and the 50-day moving average is going to be different. But I use the daily chart. I'll tell you, in December, all my holdings went on the sidelines. Actually, 50% of my holdings went on the sidelines in December. Why? Because price fell below the 50-day moving average. It's not good. And then a few weeks later, price went below the 200-day moving average. And then I went 100% to the sidelines. Right now, the 50-day moving average is crossed below the 200-day moving average, and we call that a death cross. So if you want to be really safe, you'll wait till the 50, 200. We call that a golden cross. But I'll start slowly sneaking back in above the 50. I'll sneak back in above the 200. And then when we get that golden cross, I'll be 100% off the sidelines. But just using that moving average saved me a lot of my net worth. It's been feeling good being on the sidelines.
Right.
All right. So I'll just look forward to you telling us when we have those points on your weekly slide, so I can start tiptoeing back in.
Yep.
All right. If you can stop sharing your screen, and let's go into a wrap up. Todd, why don't you do your Mr. Win by Noon coaching wrap up, how to make this actionable, and anything else that you want to make sure the audience hears before we close out.
I'm going to steal your idea, Dave. You need some insight slides. And so I would go back through. Dan's going to share these slides he said in the group later. And I would go and pick out your top 3 to 5 slides that you really liked, that you feel like you can tell a story about. And so that way, when you are on the line with a client or realtor and they're having troubles understanding what you're trying to explain, you can say, well, real quick, hey, just let's jump on Zoom, right? As Keith Collins says, even my grandma has Zoom, and jump on Zoom with them and share the slides and show them those slides and explain to them what they are. Or even better yet, take those slides, record a video, and then send it out to your database and all of your realtors. The bottom line is that this was great information for you as someone who needs to be the guardian of your own net worth and your wealth based on what Dan's talking about within the market. But more importantly, it's great information on you and where the market's going as in your profession. You're a mortgage professional, and that's your job. And your job is to do that. And Dan just gave you the slides. Dave gave you the title, the slides of insight in order to be that professional. And you just have to go take action.
So guys, I'm going to close out. I've gone over it and I've pulled it up many a times where I have this list of best practices for presentations. And I started doing this in April of this year because it was just the economy and how things in the economy were a big deal. I created this insights deck. And again, I do give presentations to large audiences, and I often start with, hey, I did my first loan in 1986 when rates were 10.25 at 3 points. And guys, here's a slide that showed, how much rates had come down right before I entered the business. And I thought I missed it. Like, I got in the business, I'm like, I missed it. Little did I know that we had 30 years, who knows how many years of a declining interest rate market. So, got into mortgage at the right time. But I've been building out these slides for a while now, and yesterday I was on this webinar where it was with Rob Chrisman and Mike Frantoni, a CEO, and they shared some slides on economic forecast, and I added those to my insight slide. And when I get Dan's slides, I'm going to look at those, and I already saw 2 of them for sure that are going to go into this deck. But I just want to make sure you guys are, you're building decks. I mean, the 2 most important things when you're presenting is you need to make complex concepts simple, and part of the way you do that is visual. And so a total cost analysis is the way you deliver rates and fees and mortgage strategies to a consumer. But I do think in a market like this one, we need to have some, that insight deck, and I don't think it should be less than 5 slides. I do think when it gets to be more than 20, it becomes like too much, and you might want to weed the garden, so that, when you go into that battlefield, whether it's a realtor, financial planner, consumer, you're just ready. You got everyone gets a TCA, and when you need to show a slide, make a complex concept simple, talk through a concept, you're there to do that. Dan, you are the guest today. Any final words of wisdom before we wrap it up?
No, and in fact, I'm so sorry, but I have a Zoom meeting in 2 minutes, so I
See you later, bro.
I have to jump.
Take
All
care.
right,
Take care.
love you, brother.
Good
See you
seeing you.
later.
Love you.
Bye.
Love you. So remember, guys, check out the links. We put links for you to get to Dan. I also put my mobile number in here. Now that I am the Chief Innovation Officer, I'm running an innovation lab. So if you want to get updates and what I think are the most important content, not only content that we create at Mortgage Coach, but I'm going to be looking for what's the best thing coming out of the Win by Noon community? What's the best thing coming from Todd Ballinger and his Borrow Smart community? What wherever I see an insight that I think will help you be an innovator, I'm going to let you know what it is. So the number is 949-799-0837. It's in chat. All you got to do is text that group and you'll be in it. And it's not every day. It's not even every week. Some weeks I'm sending out, 3 and 4 messages. And then sometimes it goes a couple of weeks where there just wasn't something important that I wanted to make sure you saw. So make sure you're in the Innovation Lab mobile community. And Todd, any last words, and we'll call it a day.
No, I just think it was, I love what you're doing in the Innovation Lab. I think that new role for you is just, going to be such a gift for our community to give you more time to think and create and make us all look smarter. And I just encourage all of you to stay plugged into the community and really just take action. I mean, the bottom line is you either watch this for an hour live, you watch this on YouTube, maybe you sped it up a little bit. It didn't quite take you an hour to see it. But the bottom line is that there's just great actionable information. And I'm always surprised when I talk to loan officers who tell me how much time they spend consuming And then I get, great, what action did you take? And then they pause and they just haven't taken the action. So don't let that be you. It's a, a great day, a great opportunity in a market where maybe it's a little slower. And so maybe it gives you that time. So just encourage you now more than ever to take something from today and make it happen.
And one last thought, I just thought of this, and traveled this last week, and on the way out, I had the mortgage coach shirt on, and literally the security person, hey, I see that before, your mortgage coach, so and then the person I sat next to asked me a question. Oh, you're in the mortgage business? If I'd have been a loan officer, I would have got a loan, and I would have had a new relationship. And then flying home, I had this shirt on, guys. And the person sitting next to me, like, oh, what's no bar left behind? My Uber driver was like, what's that? I would have got a loan, and I would have had a conversation, a new relationship. So you want to represent the show, you want to represent what we do, go to the Win by Noon store, get a mortgage coach shirt, get a Win by Noon shirt, get a No Bar Left Behind shirt, represent out there in the marketplace. We are changing the future of lending. You got to win by noon to do that. And you have to be part of this No Bar Left Behind community. So have a great weekend, everybody. This is a wrap. Give it a like if you got value, and share this with your mortgage friends. Take care, y'all.